All right, let's get into it. Today, we're going to pull back the curtain on exchange-traded funds, or ETFs. Now, most of us have a pretty good idea of what they are, but very, very few people understand the incredible machinery that's working behind the scenes. And once you do, it gives you a whole new level of confidence in your investments.
Right, so this is the basic definition we all learn. You buy one share of an ETF, and suddenly you own a tiny piece of hundreds, maybe even thousands of different stocks or bonds. It's diversified, and you can buy or sell it on an exchange, just like a single share of Apple or Google. Simple enough, right?
Well, that simple little click kicks off a really fascinating process. How are those shares even created in the first place? What keeps the price you pay from drifting away from its true value? And who are these powerful, kind of invisible players that make sure the whole system runs smoothly? That's exactly what we're going to unpack.
And look, this isn't just for fun facts. When you really understand the engineering behind the tool you're using, you can use it with so much more confidence. It stops feeling like this mysterious black box, and it starts feeling like a transparent, dependable system you can rely on.
And this system is just massive. As of June 2025, the US ETF market alone was valued at a staggering $11.5 trillion. So this is not some niche product. It is a fundamental pillar of the modern financial world. So, to really get how this all works, we first need to meet the cast of characters. See, an ETF isn't a standalone thing. It's actually the center of a whole dynamic ecosystem.
First up, you've got the ETF provider. Think of them as the architects and the managers of the fund. Their main job is not to outsmart the market or predict the next big thing. Nope. Their job is to follow a set of rules, that's the index, as precisely and as cheaply as possible. They're all about execution, not prediction. And this right here is that set of rules, the index. It's the ETF's blueprint. It's a mechanical guide that says what to buy, what to sell, and when to do it. And this is so important because it strips out all the emotion and human bias that so often leads investors to make bad decisions. The ETF just follows the plan, period.
Now, this is where it gets really cool. This is the player you've probably never heard of, the authorized participant, or AP. These are the heavyweights, think big banks and massive trading firms. They are the only ones with a special license to create or destroy ETF shares, and they act as this absolutely essential bridge between the fund itself and all of us trading on the exchange. And that role brings us to the absolute heart of how ETFs work. This mechanism, called creation and redemption, is the engine that makes the whole vehicle run so smoothly. So let's play this out. Imagine a certain ETF gets super popular. Everybody wants in. So many people are clicking buy that the price you see on the stock exchange actually starts to creep up, trading for a little bit more than what all the assets inside of it are actually worth. This is the signal for the authorized participants to spring into action. They see that little price gap, that premium, and they spot a risk-free profit. So first, they go out and buy up the actual stocks and bonds that the ETF is supposed to hold. Then they take that whole basket of securities and deliver it to the ETF provider. In return, the provider mints a block of brand new ETF shares and hands them to the AP. And finally, the AP sells those new shares on the open market, satisfying all that investor demand. This big injection of new supply immediately pushes the ETF's price back down, and poof, the gap is closed. It's a really elegant solution.
Okay, but what about the flip side? Let's say an ETF falls out of favor, there's heavy selling pressure, and its market price actually dips below the real value of its underlying assets. You probably guessed it. The exact same process just runs in reverse. The APs see that the ETF is now trading at a discount, so they start buying up those cheap ETF shares on the exchange. They bundle up a big block of them, take them back to the ETF provider, and redeem them. The provider then cancels those shares, removes them from circulation, and in exchange gives the AP the actual basket of stocks and bonds. This reduction in supply on the market pushes the ETF's price right back up to where it should be. It is a brilliant, self-correcting system.
And this constant balancing act is precisely what keeps ETF prices honest. It's all thanks to a classic financial concept called arbitrage, which acts like an invisible hand that's always guiding the market price. Now, to get this, you need to know about something called the net asset value, or NAV. This is not a price set by buyers and sellers. It's a hard calculation. The total value of everything the fund owns, minus any expenses, divided by the number of shares out there. You can think of it as the ETF's true fundamental worth at the end of each day. It's the fund's anchor.
So you have these two numbers in a constant dance. You've got the market price, which is bouncing around all day based on supply and demand, and then you have the NAV, which is that steady, calculated anchor, the true north of the fund's actual value. The entire system is designed to keep that market price tightly tethered to the NAV. And this just brilliantly illustrates the genius of the whole system. The APs are just motivated by their own self-interest to make a tiny, low-risk profit from those little price gaps. But their actions, this arbitrage, directly benefits every single one of us by ensuring the price you pay on the exchange is always hugging the fund's true value.
Okay, so that was a pretty deep dive into the mechanics, but why does any of this matter to you as an investor? Well, let's talk about the real, tangible benefits that this whole system provides. First and foremost, costs. The sheer efficiency of the system, plus some fierce competition, has driven expenses way, way down. Back in 2005, the average equity ETF investor was paying about 0.28% in expenses. Fast forward to 2024, and that had been chopped almost in half, down to just 0.16%. That's more of your money staying in your pocket and compounding for your future. Second is tax efficiency, and this is a huge advantage that's baked right into the ETF structure. Remember when the APs redeem shares and get the underlying stocks back? That's called an in-kind transfer. And because the fund isn't actually selling stocks for cash, it doesn't generate a taxable capital gain. This means the fund can essentially get rid of its most appreciated stocks without triggering a tax bill for all the remaining investors. It's a huge structural plus.
And third, liquidity. An ETF's ability to be bought or sold easily actually comes from two different layers. You have the on-screen liquidity, that's just all the other investors buying and selling the ETF shares, but underneath that, there's a much deeper pool, the hidden liquidity of all the underlying assets. So even if an ETF doesn't seem to trade very much, if it holds very liquid stocks, an AP can always step in to create or redeem shares, making sure you can get in or out when you want.
So, here's the bottom line. This whole hidden engine, the APs, the creation and redemption, the arbitrage, it isn't just a bunch of technical jargon. It's a robust system specifically designed to deliver fair prices, low costs, tax efficiency, and deep liquidity, all of which adds up to investor protection.
You know, when you finally see all the pieces working together, it really does change your perspective. It's not just some ticker symbol you buy and sell. It's an elegant, transparent, and incredibly reliable system that's designed to give you access to the markets. And understanding that, well, that's a really powerful thing.